The first indicator we are covering is moving averages. The most basic of moving averages is simple moving average. A moving average is the average of the closing price of a security over a specified number of periods. Moving averages smoothen out short-term price fluctuations and give a clear picture of the market trend. Usually, analysts use simple moving average, which weights each price equally in the calculation of the average price. But some analysts prefer using exponential moving averages, which give greater weightage to recent prices while giving exponentially less weight to older prices. Let's start by looking at the formula for a simple moving average. This is the formula for simple moving average. Essentially, if you want to calculate simple moving average for 5 periods, so for example, if you want to calculate 5-day moving average, then you take the closing price of the last 5 days and you add them up and divide them by 5. So n here represents the number of periods for which the average is being calculated, and you add the closing price of the security for each of those periods and divide it by the number of periods to arrive at the simple moving average. Now let's break this formula down into subparts. This is just a different way of rearranging the same formula because we are trying to make a simple point here. So for a 5-day moving average, what you have is you divide each day's closing price by 5 and then you add up each of these values to arrive at the simple moving average. What this means is that weight associated with the price on a particular day is 1 by 5. So 1 divided by n is the weight associated with the price on any particular day. In this sense, simple moving averages weigh each price equally in the calculation of the average price. This is in contrast to exponentially moving average and weighted moving averages, which we'll be covering later. Now the question arises, what should be the value of n that should be used to calculate a moving average for analysis? Now the number of data points included in a moving average would depend on the intended use of the moving average. So for example, a 20-day moving average is used because a month contains roughly 20 trading days. Also, 60-day moving average is commonly calculated because it represents a quarter year, which is 3 months of trading activity. So 3 months multiplied by 20 trading days every month, and so you get to the figure of 60, and hence you can use 60-day moving averages to represent a quarter year of trading activity. Now moving averages can be used either in conjunction with the price trend or in conjunction with one another. They can also be used to determine support and resistance. We'll see this application in later slides. Now let's look at some other types of moving averages first. The next type of moving average is a weighted moving average. Now in case of simple moving averages, what is found is that many times a buy or sell signal is quite delayed. Now to overcome this, many technical analysts use a weighted moving average where the data are weighted in favor of the more recent data. Because more weight is attached to more recent data, weighted moving averages reverse direction more quickly than a simple moving average. Now let's look at how one can calculate a weighted moving average. The first step in determining a weighted moving average is to define the sum n for n periods. So for example, if we are calculating a 5-day weighted moving average, then we calculate the sum of numbers from 1 to 5, and this is what is represented here by sum of n. Next step is to calculate the WMA by using the following formula. What you need to do now is multiply the most recent data by n, which is the number of period. So what you will do is that if you are calculating a 5-day weighted moving average, you will multiply the last period closing price with 5 and divide it by sum of n, which we calculated in step 1. Then you take the closing price for the second last day and multiply it to n minus 1. So you will multiply the second last day to, in case of a 5-day moving average, you will multiply it to 4. And you again divide it by sum of n. And you calculate all these fractions and then sum it up to arrive at the weighted moving average. Now what this does is that it attaches greater weight to the most recent price data, and the weight proportionately reduces as you go back in time. So in case of a 5-day moving average, the price for the last period will be assigned the greatest weight, and the price for the t-5 day will be assigned the lowest weight. So this is how a weighted moving average is calculated. Next, let's look at exponential moving average. Now in order to construct a 20-day exponential moving average, what you need to do is first construct a 20-day simple moving average. The simple moving average becomes the starting point for your calculation. Now let's say if the simple moving average value for day 20 is 42 and the simple moving average for day 21 is 43 and the simple moving average value for day 22 is 44, the next step is to calculate the weighted multipliers as multiplier m equal to 2 upon time period plus 1. So in this case, if we are calculating the 20-day moving average, then our multiplier m will be equal to 2 upon 20 plus 1, which will approximately be equal to 0.1. The next step is to calculate the exponential moving average using the following formula. In order to calculate the exponential moving average for the current period, you take the closing price of the current period and subtract the exponential moving average of the previous day and multiply it with the multiplier m, and you add this to exponential moving average of the previous day. Using this expression, you arrive at the exponential moving average for the current period. Now the question would arise, what should you use as the exponential moving average on the first day? And the answer for this is that you use the simple moving average for the last period as the exponential moving average for the first day. Don't worry about the calculations of these various types of moving averages. All charting softwares will provide you with the numbers. What you need to remember is that in case of exponential moving averages, more weight is given to the most recent value and increasingly less weight is given to older values. In this sense, exponential moving average gives more weight to most recent closing price when compared to weighted moving average, and in turn the weighted moving average gives more weight to the most recent price compared to the simple moving average. And in case of simple moving average, all prices are given the same weight, which is why simple moving averages are slow to respond to change in prices, and exponential moving average is the fastest to respond to change in prices. Next, let's look at how to use moving averages. Now this moving average tool can be used in multiple ways. The first of which is to see if the price of a security is above or below its moving average. Now this is important because a security that has been trending down in price will trade below its moving average, and a security that has been trending up will trade above its moving average. So when the security is trending up, it is likely to trade above its moving average, and when the security is trending down, it is likely to trade below the moving average. In general, what this means is that a penetration of a moving average is a signal that a change in trend may have taken place. In general, the longer the time frame of the moving average, the greater is the significance of this crossover. The next important application of moving averages is that they act as support and resistance zone. If you look at this price chart, you see that how when the prices move from far away from the moving average to close to moving average, then moving average levels act as resistance to this upward price trend. Also, what you will see is that once prices have moved far away from a moving average in the upward direction, and then if prices were to return near the moving averages, then moving average levels act as support zone for the prices. Apart from this, moving averages are also used in conjunction to generate buy or sell signal. For example, one may use a 20-day and a 60-day moving average to determine emergence of a buying trend. A 60-day moving average is smoother and less volatile than a 20-day moving average. This is because 60-day moving average uses more data point to generate the moving average, and hence any one extreme data point is going to have a lesser impact on a 60-day moving average than a 20-day moving average. This can be gauged mathematically by the fact that the weight of each data point is 1 by 60 in case of a 60-day simple moving average, and the weight for each data point would be 1 by 20 in case of a 20-day simple moving average. In general, longer the time frame used in creation of a moving average, smoother and less volatile is the line. Investors often use moving average crossover as a buy or sell signal. When a short-term moving average crosses a long-term moving average from underneath it, then this movement is considered bullish. So for example, here the 20-day moving average crosses the 60-day moving average, and this is what is called a moving average crossover bullish signal. Now this movement is considered to be significantly bullish and so is appropriately named as the golden cross. Now the inverse is also true. If the 20-day moving average was to cross the 60-day moving average from above it, then it would be considered a bearish movement, and such a moving average crossover is referred to as the dead cross. So this is how you can use moving averages for analyzing any security.